Hello and welcome back to Options Arena by True Options Masters. I'm here as always with Michael Carr, Adam O'Dell, and Chris Cimorelli joining us once again for his battle in the arena with our Options Masters. This week, we are at a crossroads. The bull market is on the cusp of seeming to begin again. We're almost 20% off the lows. We have made a higher high on the chart. There's lots of bullish indicators in terms of whether or not we're in a recession. But at the same time, the Fed is still hiking rates. Inflation is still really hot. So there's a lot of stuff to be worried about. There's a lot of stuff to be positive about. It seems really split right now whether or not we are going to return to a bull market with yet another V-shaped recovery, or this is a bear market rally that's about to fall apart once again. So I asked our True Options Masters this week, are we going to go back into a bull market, or is this bear market really just getting started? So if you like this content, be sure to like and subscribe. We really appreciate your support on the channel. Make sure you're reading True Options Masters, the greatest options trading newsletter on the planet. And we'll not waste any more time and take it directly to our Options Masters. Mike Carr, I want to start with you this week. Are we in a bull market or is it a bear market?
Well, I'm going to show a few slides here. And what I want to show is in your original prompt, you noted that the non-commercials have a large short position, and that's what's in this chart. So this is the futures contract E-mini S&P 500. And what happens in futures is every time somebody buys or sells, they keep track of whether it's a long or a short trade. It's real easy to shorten futures, so it's an effective way to hedge a portfolio. And you have to report those trades. So the green line here is commercials. These are funds that are just using the market to hedge, maybe insurance companies. Black line is these non-commercials. These are the hedge funds. In reality, they're large speculators trading at least a couple hundred contracts at a time. And then the red line, that's the small speculator. The people like you or me may be trading 1 to 5 contracts at a time. So you're right that the non-commercials do have a large short position. But at the bottom of the chart there, I converted that to an index so that we can get an idea of how bullish or bearish they really are. And what this tells us is the commercials are the most bullish they've been in 2 years, while the hedge funds are the most bearish they've been in 2 years, along with the small speculators. This is the kind of market that is really set up to move higher. Commercials are the smart money. Generally in futures, when we see this index near 100%, markets go much higher. When we see all of the small speculators loaded into one side of the market, we tend to see a reversal. So this chart is very bullish. But interestingly, this setup does not extend to all indexes. In the NASDAQ 100, these are the tech stocks, Netflix, Amazon, Apple, Google. These are the stocks that led the bull market. Commercials are stepping aside. They're becoming a little bit more bullish, but they're still net bearish. And that's on the index down here. And the large speculators are the ones buying. So this is actually kind of supportive of the market. If the market does keep going up, commercials are going to have to buy in. So this chart is different, but also bullish. But the real surprise to me is small caps. E-mini Russell 2000. Commercials off the charts bullish right now. Everyone else bearish. Commercials tend to know something that's going on in the market. They're the proverbial smart money. They like small caps. We should like small caps too.
Very good stuff, Mike. So not only bullish, but especially bullish on small caps in this environment. Watch the commercial traders. All right, let's move it right along to Adam O'Dell. Adam, what do you have for us today?
All right, well, I'm going to have to take the other side of that trade or call, so to speak. I'll share my screen as well. Just a simple chart of the E-mini S&P futures, ES. So yeah, I'm going to say that I'm a cautious optimist. And right now, I just believe that it's going to be more prudent to lean more toward the cautious side of that cautious optimism than the optimism side. We know that trend changes take a while to happen. We saw a trend change from bullish to bearish at the beginning of 2022. And the simplest way to define a trend is a series of lower lows and lower highs in the downtrend, which is what we've seen. And then the simplest way to define an uptrend is a series of higher highs and higher lows. Mike, you actually mentioned that we had started to see a higher high, and that's true. Over the past week or so, the S&P 500 did break above 4,200, which was roughly the swing high at the beginning of June, right before we fell to the latest lows. But I'd like to see another series of those. I'd like to see a higher low. So I'd like to see if we pull back from that 4,300, I'd like to see the S&P hold at 4,000 or even 3,900 and really hold above those mid-June lows and then carry on to new highs at 4,400 and from there. So that's kind of what would change my base case scenario from bear to bull at this point. Also, if you look at the S&P 500, we're kind of just in a downward trending channel. And if you connect the highs of January and mid-March and to current highs, we really need to see a lot more follow through on the bullish side to call that downward sloping trend channel broken to the upside. Otherwise, we could see stocks roll over right now. I'll also note that the RSI just on the S&P 500 just hit overbought territory this past week. So that's the first time it's been overbought since November of 2021, so the prior bull market. So this is kind of a logical both time and place on the chart for the rally to run out of steam. 4,300 on the S&P 500 is also a former very strong level of support. And as we know, support often turns into resistance once it's broken. So again, I'd like to be more optimistic than I am, but right now I'm kind of staying on the caution side, and I do think that it's better to plan for the potential that the bear market could go longer and lower.
Very good stuff, Adam. So we have Mike Carr bullish because of the commercial traders. Adam, a little bit more bearish due to the chart pattern. Adam, I'll just say I hope you're right because I sold a ton of my stocks a few days ago at what I think are pretty good prices. Without further ado, Chris Cimorelli, what have you been thinking?
Well, we're going to have three different opinions in the options arena today. And that might sound strange. How can you have three different opinions if the options were only if the market's going to go up or higher? And the truth is that I'm straddling the fence right now. I think that the market is at a very key inflection point, and I think that support and resistance is going to determine where it goes from here. But I do want to show a chart real quick. Okay, so this is a chart of the Invesco QQQ Trust, which tracks the NASDAQ 100 during the summer of 2000. Now, why the summer of 2000? Well, because around this time, 22 years ago, we saw a very similar trend in this rally right here, where we saw the market go up in a more or less narrow channel and then just turn on a dime in what happened to be September 1st, which September also happens to be the worst month for stocks, historically speaking. So while it looks like the current rally, and we can scroll to that in a second, is looking pretty strong, it is important to know that these can turn on a dime. Now, something I noticed while looking at this chart is that volume, which you can see in these bars down here, was shrinking as the market was heading higher during this rally. So, and if you zoom out a little bit, you can see as the market was going up, it was trading on higher and higher volume, and then volume stayed pretty elevated, but it did very clearly start to shrink around this time. So let's scroll back to where we are today. It's amazing how much time has gone by. And we're going to see what I think is a pretty similar setup where, again, looking at the bars down here, volume has been decreasing, not sharply, but it has been decreasing steadily. So what that means is that there aren't as many investors who are participating in this most recent rally. Now, that's both a good thing and a bad thing. Well, how can it be both? Well, in the recent rallies, the market sold off too far too fast, rallied too far too fast. The market was being controlled by animal spirits, panic selling followed by panic buying. And when you panic buy, prices sort of reach their tipping point faster and they go reverse in the opposite direction. So on the one hand, it's good that this climb has been a little steadier because it means that It's giving volatility a little bit of time to ease. So there is the possibility that it could continue going higher because it has been steady, because it's been less of an erratic climb. But as we saw 22 years ago, it can turn on a dime. It is important to note that we have broken a trend line here. So this was pretty good resistance. We broke through it. Doesn't mean we're going to stay above it. But I would like to see where it goes from here. If it stays in this more or less narrow channel, then it can keep going higher. But as volume continues to decrease, I don't feel good about it. The generals can lead the market higher, but if the troops don't follow, I don't see this rally lasting much longer. So sort of straddling the market right now for me, and I am looking to see what happens over the next 1 to 2 weeks before I deploy any serious capital. I'm waiting for that real good trade.
A very measured take, Chris. Very helpful stuff. I like this is why I love Options Arena so much. We have a very focused topic, but we have 3 incredibly different ways to look at it. We have the commercial traders and the non-commercial traders. We have the technical pattern, and we can learn a little bit about declining volume as well, putting us into rollovers. So that's going to wrap it up for this week. Again, like and subscribe if you enjoy this content. Much more importantly, be sure to check out the True Options Masters newsletter, the greatest options trading newsletter in the world. And we will see you next week for the next Options Arena. Thanks so much, everybody.